Hi, and welcome to the �ґ Show. I am your host, Jennifer Gellatly. I'm really excited to share this information today with our special guest, Jiang. He has extensive experience in banking, arranging mortgages, consumer debt consolidation, residential and commercial lending, and really guiding his clients in a holistic way through their wealth strategies. Welcome to the show today, Jim.
Thank you, Janie. Appreciate your time. Hello, everyone. It's awesome to be here today.
Yeah, we're so excited. I was thrilled that you agreed to come on the show, and I know that our audience is really interested to hear about mortgages. We've gone through quite the roller coaster of mortgage rate increases over the last 24 months. And now with everything going on geopolitically, there are a lot of questions in the air regarding what we're going to see with interest rates on mortgages over the next year or so. So thank you for joining me in the conversation. I really want to break down the discussion into 3 segments. So the first segment, let's talk about consumer debt consolidation. The second segment, we'll talk about residential mortgages. And the third, we're going to end with commercial. All right?
Perfect.
Great. So my first episode, I shared some really personal information. I come from a divorce, and I have what a lot of people have that they keep very silent about. I had a negative net worth into the tens of thousands of dollars. Actually, a very close friend of both you and I, and a client that we have in common, is also a banker. I had sent him all of my debt information. He ran a bunch of numbers and he was like, I've reviewed this for you, Jenny, and it's going to take you 52 years to pay off your consumer debt and your student loan together, those amounts with the interest rates and the amount payments that you're making each month. So what he advised me to do at the time was roll that debt into a mortgage that I already had, right? So let's talk about this a little bit. First of all, just share, is this possible for people? Can they roll credit card debt, student loans, lines of credit into a mortgage?
Yeah, that's a great question, Jenny. I think that is a very important question for most consumers out there. The short answer is yes. Now, there is a condition to that, which is they have to have the equity in their home in order to take on these debt amount. If you have the equity, the short answer is going to be always beneficial for you to roll personal debt that you carry on a monthly basis, that you do not pay off in a short period, into your mortgage. And the biggest reason is because of interest cost. Interest cost on a mortgage is much lower than the personal line of credit or personal debt. At the same time, with a mortgage, a lot of cases you are able to amortize over 25 or 30 years. I think there is a misunderstanding that it will take you 25 to 30 years. I think people forget most individuals out there tend to pay off their mortgage much quicker than what they signed up for. And there's a lot of reasons behind that. Most people trying to pay them down quick. They sell their home, they made money from their home, and they pay off a large chunk. But in general, I find if you're able to amortize over 25 or 30 years, the benefit that gives you is that you are able to have a reduced monthly payment of cash outflow versus a personal loan that sometimes only they allowed you to amortize only for 6 years or so, right? Or 5 to 6 years. Because of that reduction in cash flow, you are able to catch up even quicker and not get into this kind of debt spiral per se. And when your situation changes, or when interest rate is lower, or other kind of factors that improves your cash flow, you are able to pay it faster. And that is the overall benefit why putting into a property has the most benefit versus carrying on a personal name.
Absolutely. You know, people go, okay, how am I ever going to buy a house when I have 10,000, 20,000? Like for me, I had 30,000 in consumer debt. Plus I still had a balance of at least another 30,000 in the form of a student loan. So we're close to like negative 60,000 net worth. What I quickly realized with the help of discussing this with wealth experts and financial experts, first of all, talk to smart people. Get ideas from smart bankers. If you're not a banker yourself, you got to surround yourself with really good banker friends, such as Jim. But I realized, you know, I'm never going to be able to pay this down with the strategy and the path that I'm on right now. So my strategy that I executed was I actually made the minimum payments on those debts a month. And then I also saved because the bank was not going to allow me to use any form of credit as my down payment on a property. But they would allow me to make the minimum payment obligations on all of those products. And if I could show a demonstrated history of saving $15,000, whatever it might be, $20,000, and they could see the history of that, that is how I did it. That is how I bought a house. That's how I bought my first piece of real estate, going from a negative net worth to then having ownership in an asset, right? What would you say to someone trying to determine, you know, should I just try and pay this off first, or should I try and form a plan to build savings and buy a piece of real estate so I can get out of this net worth negative hole that I'm in?
Right. I think the short answer is kind of the non-answer, which is it depends on your situation, which requires careful planning and understanding your needs and your current situation. What I mean by that is, if say you are able to make the minimum payment and therefore save additional cash so that you build up the down payment available for a real estate purchase, then of course mathematically, if you can qualify for that with the income that we can use, then that means, and technically you can do that. Now that depends upon also the needs of a property, right? How much of a need in your property. I have situations where clients get notice from their landlord saying you got to get out in however many days, and they have to look for. They didn't think they're gonna buy this quick, but they have to make that move earlier than they anticipated. Or you see there's opportunity in the market that, you know, if you're in a buyer's market, potentially you are able to get something at a much lower value that you think in the future it will have a higher gain per se than the debt that you carry on the personal level. It is a bit of a balancing act. But the key point is that ultimately you have to plan ahead and understand that if you did this, if you have this much down payment, can you have the income to qualify for the mortgage that you want to get at the same time maintaining the debt that you have? If the answer is yes, then definitely it's a tactic and strategy you can utilize. So that piece is important because we have to plan ahead.
Yeah. You answered the question so well by saying it's really on a case-by-case individual basis, and it requires underwriting and specifically looking at the person's situation. I was fortunate enough to have my banker friend do that for me in great detail, right? So the end of this segment really is this is possible. You know, you might be able to roll your debts into home ownership in some way, but people really need to seek that expert advice that can really only be given once someone like yourself can review their financial situation in detail.
Exactly. I think the most important thing you brought up is, I think, is to have that conversation if you early on, or discuss with somebody who's in the field, because sometimes clients don't know They just simply do not know. Now, I have situations where I had a conversation with client and they're very surprised on what they can afford. I also had some situations where, once we run the numbers, the clients realize, you know what, I could do it, but I probably feel more safe. I'm a more risk adverse person. I probably will feel more safe by once my debt get to this level. Because of that, we come up with a plan on how they can tackle it. And I advise them on which debt should they focus on first. So regardless what the outcome is, I think the most important piece is having that conversation, knowing your position, knowing what the future is could be like, and how to get there if not now.
That's fantastic. Thank you. Let's move into the next segment, which is very relevant for you and I right now. We're going to talk about arranging mortgages for single-family residential. Jim and I have had the pleasure of working together very, very recently. So we completed a transaction last Q4 together at the end of 2025 with a shared client, first-time home buyer. And we're working together to another transaction right now, another first-time home buyer. So I love working with you. I am a licensed real estate agent. And for anyone who's in the Greater Toronto area, I cannot recommend Jim enough. He really works closely with those clients to help them understand their affordability. And you've done such a great job with getting any financing condition waived for me quicker than usual. So I gotta say thank you on air for that.
Appreciate it.
Because I really we pushed it a little bit, pushed the envelope.
Yeah.
So I really
Yeah.
appreciate that you went the extra mile. And it's something that small, well, not small, it's something that important that helped us get the deal done, right, in a very competitive bid process. So just let's kind of move out with a 30,000 foot view here of arranging mortgages for single family residential in Ontario or in Canada. What's the minimum percentage required down in equity and cash for someone?
So the big piece here to remember is there's two major kind of a cash outflow that you have to prepare for. One is the down payment, the other one's the closing cost. Now, if we're looking at down payment, typically on average is 20%, but we can go less than 20% through government kind of backed program. There's obviously pros and cons with that program. The pro is that you are able to get into the real estate market if you can qualify with less than 20% down. Obviously, the trade-off is that it is still a quote unquote insured program, which means that the government is backing the loan, and then there is a premium that needs to be paid for that. The premium is paid one time only at the origination of the mortgage, but usually we are able to wrap that cost into the mortgage itself. So if you're going through that program, the calculation is that it's going to be minimum down payment of 5% on the first 500,000, and then 10% of the purchase price from 500,000 and above, up to just under 1.5 million as the top cap purchase price. So basically, if you're buying a property for 500,000, the minimum down payment will be the first category, which is $25,000. If you're buying a property for $1 million, then the first 25,000 covers the first 500, and then another 50,000 covers the remainder of the 500,000. So total, you need about $75,000.
Yes. And also taking into consideration any land transfer tax, right? Because the buyer is responsible for paying that land transfer tax. You can find land transfer tax calculators online if you're looking to try and determine what that soft cost is to close on your transaction, and your legal fees too. You do have to reach out to lawyers to see how much they will charge you to successfully close as well. So, let's talk about this a little bit.
Mm-hmm.
I am not a super seasoned banker such as yourself, right? But I am pretty entrepreneurial. I now have a lot of investments in real estate. I did not start out that way. And I did go with 5% down on my first house, and I'm glad I did. And it's difficult to determine, do I want to go in at 5%? And really, you're way overpaying on the value of that property because of the insured amount, right? Like if you're looking at the calculation, you're really overpaying. But at the same time, it's a delicate balance, right? Because the longer you wait to get into the market, the more the valuations have gradually, annually, year over year increased in that market. So it's going to take you 5 years to save up 20% on a $500,000 property. What is that $500,000 property worth 5 years later in the same market, right? If it's Toronto, the change could be dramatic, whereas outside of the GTA, it's not as severe of a swing. So talk to me a little bit about that. Like, how do you run scenarios with someone on wait to save the 20% or don't just put down 5%? Let's go for it.
Right. I mean, ultimately, I think it is up to the client in terms of making that decision on, whether they see a property as well as with your help to figure out if it's a good deal or not. I think if there's a justification that is a great deal, right? It's a steal, and you are in this buyer's market, that by simply taking the move now, you're likely to get benefited and not waste the opportunity. There is definitely a argument for making that kind of first step right now, right? The other thing I want to mention is that some cases depends on client situation. As I mentioned, client who has been renting for a while, changed a few places. Now they have a family, kids on the way. They want some stability. They want to have their own place. They want, not to think about moving around. And in a market that they think they can get a good deal and they can qualify for with less than 20% down, that might be a good call for those type of clients, right? So I think it depends on the clientele, what they want to do. Or, for example, you might be wanting to use part of your down payment to pay off some other debt or invest in something else. So it's all depend. That's why it's very personal, because it depends on each person's opportunity cost in terms of what is available out there, right? Maybe a client can use some of that money instead of doing 20%. They can use that extra money saved to do a small rental for their property or buy some furnitures so that they're moving in ready. So those are all part of the conversation we have with clients, just to make sure, we fully understand what's their need in order to help them advise on that front.
Awesome. Basically, same answer as the first segment. They really need to work closely with someone like you, right? To run these scenarios. And the more detail they share with you, the better off they are, right? Here's the total amount of cash I have. I want to buy a piece of property. I might want to renovate a little bit and spend $5,000 renovating or painting. Oh, but there's this investment opportunity over here. Here's the projected ROI, and really bring you the full picture, right? So that you could better advise them. So let's move into this last segment and talk about something I'm extremely passionate about and have a lot of experience in, which is commercial real estate. So what asset classes have you done the most work in as it comes to commercial lending and mortgages?
In terms of real estate commercial lending, probably in the multiplex and warehouse space, some mixed use and office space. But in terms of what's popular, I think in general at this moment is still the multiplex as well as the warehouse space. And in terms outside of real estate, I also do advisory for business growth, merger acquisition, as well as working capital growth needs that potentially helping client get more financing through their bank or through alternative lenders.
Now I'm going to pepper you with questions. So I'm a landlord. I do have a portfolio of apartment buildings, smaller apartment buildings, right? So 6-plex, 9-plex, like, kind of under 12 per property. What is the loan to value ratio you're looking at? Like, what's the minimum equity and the loan to value ratio on a property that has more than 4 units?
Typically, it depends on whether you want to go through the CMHC program or not. The CMHC program essentially is there to kind of push forward for investors to get into this space so that there's more potential rental units available.
Yeah, so the type of units that we do the most is probably with multiplex, warehouse, some mixed use and office units. And additional to real estate, we also do advisory to companies who are looking to maybe do a merger acquisition, buyout, or trying to improve their financing with working capital, leasehold improvement, whether if it's from the banks to get additional capital or from alternative lenders or as well as institutional funding. So those are more on the advisory piece with regards to business growth. But real estate wise, yeah, I think the most we do is probably multiplex and warehouse.
That's great. Warehouse is really hot. It's the cap rates on warehouse properties in Ontario have been very good the last couple of years compared to some other asset classes. I do really want to talk about multifamily real estate selfishly because I do like to invest in multifamily real estate, and I think it's a great way for people to start building their wealth. Usually what I've seen, I've been in franchise development for 15 years. Usually what I've seen is every single self-made millionaire starts with a real estate portfolio, right? They buy their first house, they refinance that house, they buy their first rental, then maybe another rental. They keep refinancing properties and keep acquiring, which is really what this show is about. And then they graduate maybe to apartment buildings, and from real estate and multifamily, they often graduate into businesses, right? So it sounds like you do all of it. It's not just real estate under the commercial arm. We did talk a little bit before the show as well. It sounds like you also do commercial lending for businesses too.
Exactly, because businesses needs capital injection to grow. And like, for example, right now I'm working with a wholesaler kind of business who ships like food kind of within Canada as well as in the US, but they're just kind of getting tapped out at the banks, and it requires some advisory on how to get additional financing. And the funny thing is, the reason they need those advice is because from the bank's angle, we always have this chicken and egg problem. The bank would want to step in when you're really do not need them, because they don't want to be the first person that leads in with the investment. And obviously the banks can only tolerate a certain risk level, so which is understandable. So I think for a business that has tremendous growth, in this case, 30-40% annually at least, there is a problem, which then they get to a point where they need more capital to grow. They don't get from the banks. The banks basically says you grow first and I'll give you the capital, but they cannot grow first without the capital to grow. So then this is where maybe an alternative lender or other kind of sources will be able to give them the funding. And to them, maybe the cost is a little bit higher than the banks, but in comparison to how much benefit they get out of it, how much they can turn, let's say $1 million into $8 million additional revenue, the net profit from that is way, way more than the interest they paid. So to them, they're very happy. It's just that the bank does not provide that. So those are the kind of the areas we help companies, structure, advise, plan, and find sources.
That is everything you just said is very powerful and very accurate. It is chicken and egg. And I was thinking to myself in my mind, we met only at the end of last year through a mutual client. We've done a couple of residential transactions together, but this episode is going to turn into, now you will be my most important banker friend. And I'm going to be sending you all kinds of numbers and spreadsheets after this episode so you can tell me how, like, what ideas there are, right? You're absolutely right, where you want to grow your business, you don't have the capital to invest in something specific to take it to the next level or to acquire another property, etc. Right? So it is important to work with someone like yourself to go over those ideas and solutions in detail, specific to the person, specific to the business. Yeah.
Right. It's very important. And sometimes too, you will also want to be mindful of the cash flow too, right? Because when we're analyzing it, we're not simply saying, yeah, you get it, and then we'll figure it out. One of the major exercises I run with my client is, imagine if we're able to get you the financing. This is the cash flow you'll be looking at. Are you comfortable with that? How comfortable are you managing? Do you have a risk management system in place? Do you have reserves? What's your liquidity like? What if there's variances between interest rates? How is your cash flow is going to change then? So it's a more diverse conversation in order to, to make me give them the best advice. Because if it's simply just transactional, the problem is that you can work with somebody who can get you the financing, but they're not there when there's variance or volatility in the market. So we plan ahead so that we try to avoid those situations, that the client is always feel comfortable, or at least have a plan in place.
That's very powerful. And it hits close to home for me, because I've really only gone directly through big banks up until this point, right? And depending on who's assigned to your account, you're only going to be receiving very specific communication from that bank. Whereas if business owners, investors work with someone like yourself to help you go, well, what's your percentage of capital reserve for capital improvements over and above repairs and maintenance, right? And to your point, like, what is the sensitivity analysis if interest rates change, or if there's other factors like force majeure factors or global pandemic or something that happens to dramatically impact your business, right? So it's really cool talking to you. And I can see how you are extremely valuable to your clients.
Yeah, appreciate it. The same thing, right? What I can never predict what Trump's going to say tomorrow, unfortunately. So that has a huge impact to the market, all right, unfortunately. But jokes aside, I think these are typical exercises we do. Now, I have about 13 plus years experience in the corporate side. Before, I'm a mortgage broker going on 5 or 6 years now as a mortgage broker. I'm also licensed as a life insurance broker, as well as living benefits broker. So, the thing to keep in mind is that when you're in the corporate side, obviously you would know your product well. But as a broker, and that's one of the reasons I kind of jump in this space, is because this is truly space where you can offer all the solutions. I really have no kind of obligation or someone that I need to please at the corporate side or whichever lender. My client is my top priority. There's no difference between going to one bank versus the other. It's really about who I offer the best package overall. So that gives me the freedom to do kind of the best true advice that I can get. And the funny thing is, most of the, if you're looking at US, I think Canada's a bit different. If you're looking at US, majority of the borrowers actually goes through brokers when they get their financing for mortgages. And the reality is because in the US, the financial system is quite more developed in the sense that it is more diverse. There's way more financial institutions available, that obviously you need somebody who's an expert who can choose the best product for you. Whereas in Canada, I think the main reason that most people might not have worked with a broker before is because the marketing from the major six, right, has kind of been getting easy money all day long because of the marketing. But people have to understand that this type of going to your bank, which is great if you would like to do that, is not a typical structure in sense elsewhere in the world. right? And it's only because in Canada we're dominated by the major six, right? Which is kind of unhealthy, in general, unhealthy setup. But it is what it is, right? Every country has its own financial structure. So I think right now, though broker's role is getting more recognized, once people, clients work with a broker, they realize, if you're going with a bank versus a broker, there's no extra fees that I charge. Like, people always ask, if I go with you, you're going to charge me fees. I said, no, I get paid the same way as somebody at the bank. There's really no difference. It's just a different way to generate revenue for the lender. So they're willing to work with brokers to get you the best deal. And they're comfortable with that. And that's how they feel comfortable with their product. So, once people realize all of that, the solution, the answer is, if the person I'm speaking with, who is a broker, I feel truly add value to me, right? Not just transactional, but other advisories or somebody that I can just give a call, or in that mutual client situation, when they said, this deal's coming up, we want to shorten a conditional financing date. Can we do it?
Is that like a hint, hint, nudge, nudge? That was you, Jenny.
Yeah, essentially, right? And I'm glad to do those because the clients that I work with has already gone through the conversation a week, 2 weeks beforehand, where I went through every single documentation, so we can make those moves, right?
Absolutely.
And having those phone calls at night if needed.
Yes, and on Sunday at any hour to get it done.
I was a little bit prepped for that because I know he was offering. So I was like, tonight, if he calls me, I'm going to definitely pick up and help advise him.
But you know what? That's the reason why you have the moment of joy from the people of like, yes, we've got it. Like, they're so excited to move into their new home. So to me, that is like, that's addictive, right?
That's right.
Yeah, right. Absolutely. Well, I'm gonna close out this episode by asking you, I like to try and end each episode by asking my guest the same question. In a few words as possible, can you share with us what have been the highlights of your life up until this point?
I think I can share two. One is that I'm about to get married to the love of my life soon.
Oh, congrats.
Thank you. And then the second thing is I'm glad that I made the jump from corporate to the broker space.
Wow, that's huge. Like that's so exciting. I didn't know you're getting married. When's the wedding?
It's coming up in mid-May. And,
soon.
Yeah. A lot of planning still.
Congratulations. That's
Thank you so much.
Awesome. Well, thank you so much for coming on the show. I really appreciate it.
Appreciate it. Thanks so much, Annie, for your time. I love the conversation. Hope we can have more in the future. But I hope, your audience learned something from both of our conversations today and will add some benefit to them in the future.
Absolutely. Thanks again.
Appreciate it.
Wow. Very grateful to have had Jim on today. He is so fantastic to work with and extremely knowledgeable. I will definitely drop all of his contact information in the comments to this. So please check out his website and reach out to him directly if you're interested in having a conversation regarding your finances and just planning. Do you want to buy your first property? Do you want to buy investment properties? What do you want to be investing in? And he'll be there to help you. This has been the Grow Choir Show. Have a great day. We'll see you next time.